Good morning, everyone. Welcome to America First Wealth Management Investment Outlook for July 15th, 2024. My name is Dan Liu, Chief Investment Officer and Portfolio Manager, and joining me again is Micheal Cheah, Head of Fixed Income and Portfolio Manager. Mike, please turn in that slide. This is our standard disclaimer, which we show every week. And next slide, Mike. So the big news, obviously, which the world witnessed on Saturday, was the shocking assassination attempt on former President Trump, which he survived, fortunately. It was a very close call. It was almost, I think, an inch more. He probably wouldn't be around today. So anyway, this is a very iconic photo. I think it'll be the iconic photo of the year. I think it's going to have implications for the investment outlook for the rest of the year and the markets. So we're watching it very closely. Next slide, Mike. So my prediction is that following what we saw in history after the assassination attempt of Reagan back in 1984, he won the electoral votes by a landslide versus Walter Mondale. So given where the race is today, I think it's probably very likely that Trump will win. And I think certainly a lot of the undecided voters will swing in his favor due to the failed assassination attempt. And when you look back at what's happened, Trump's been impeached, he's been sued, convicted of felonies, and now an assassination attempt, and he's still standing. So he's clearly a fighter, regardless of your politics. I think everyone will agree that he's not given up, and he just continues doing what he wants to do. While he may rub people the wrong way, it's clear that he's out for the best interest of the country and the policies that he and his party want to put forth. So in any event, I think the assassination attempt will appeal to a lot of voters and swing the vote in his favor. So anyway, that's my personal prediction, not our company's prediction, but anyway, just wanted to point that out. History may well repeat itself again. Next slide, Mike. So for the week, the surprise obviously was the certainly the reaction to the core inflation numbers, which dropped below consensus, and interest rate declined on that. The big surprise that occurred was small caps, as you can see here on the weekly market stats by the Russell 2000, shot up dramatically, up 6.1% on the week, pretty much outpacing everything. In fact, there was the day the CPI inflation numbers came out, the S&P was down and the Russell 2000 was up. And that's an event that hasn't occurred since, I believe it was October 2008. So very rare occurrence. And that was on Thursday, and same thing happened on Friday. Small caps continue to rise, but also large caps came back up on Friday. So anyway, for the week, you can see that the drop in the S&P impacted the Russell 1000 growth, which was down 31 basis points. And all the other indices were up. NASDAQ 100 barely eked out a positive return, just up 12 basis points, as a lot of the big tech and AI names lost some ground. But like I said, recovered on Friday, and we'll watch carefully what happens this week. We'll see if interest rates continue to head down. Irrespective, I think it's going to be volatile, certainly factoring in the assassination attempt on Saturday. Next slide, Mike. So as I mentioned, the interest rates dropped, and for the week, the 10-year Treasury yield actually dropped 10 basis points, not 8. I think the math is wrong there, but we closed 4.18, down from 4.28, so down 10 basis points. And for the year, interest rates are still up, but now less so, just up 30 basis points from the year end of 3.88. And Mike, next slide, turning it over to you.
Okay. Yep. So let's look at the economy. And we are seeing this chart that shows the US consumers' interest payment as a percentage of disposable income, and the non-mortgage rate have gone higher than what it was in 2010. So this increase in the interest payment burden is going to hold down some consumer spending. And if we look at the Atlanta Fed model, what we are seeing is that the model is now predicting that GDP is running at about 2%, right? Which is still slightly above potential GDP of 1.8%. Nonetheless, it's a big drop from 4, 3, and now 2. So the economy is slowing. And as Dan mentioned, we have very good inflation number. And if you look at the core CPI annualized rate, we see on a 6-month basis, it is now inching closer to 2%. And what the Fed looks at is the core service CPI. This is also coming down. To be sure, it is still rather high at 5% compared to their target of 2%, and also compared to the month-on-month annualized basis. Right? So this chart has a pattern of zigzag. So we should prepare for next month's a bounce here, right? Because it's quite rare to have a drop this month, second drop, and a third drop. And this is rather interesting, right? So this says that soft patches in inflation, in the past that we have seen have been followed by a rebound, right? And seeing data like this, the Fed may have to be cautious, and if a big policy error, if they will cut rate too soon, and then see inflation bounce up again. So as you can see here, these are the 1, 2, 3, 4, 5 recent period of soft core PC number. In September, November, 8 months later, it bounced up. August, September 2021, 6 months later, it bounced up, and so on, right? So because my worry is that we are still facing the reality of mega trend inflation because of the OPEC not willing to let oil price come down, always prepared to cut production. We're talking about reshoring. We're talking about ESG, where a lot of cost is added to make the product more compliant. So these are the things that at the back of my mind, and I'm sure the Fed is also thinking about this. Now, when you look at monetary policy, right, the key takeaway from Fed Chair Powell testimony on Capitol Hill, the first item is that he spoke about, we do not expect it will be appropriate to reduce the target range for the Fed funds rate until we have gained greater confidence that inflation is moving sustainably towards 2%. The key word here is sustainability. And the second item that I picked up is the most recent inflation readings, however, have shown some modest further progress, and more good data will strengthen our confidence that inflation is moving sustainably towards 2%. So the key word here is more good data. Does it mean 1 more month or 2 more months? Right? So a lot of market participants are expecting that the Fed will start to cut rate in September. So we are already in the middle of July. If we factor in 2 more months, that'll be August, September. So that is quite a close call. Look at the bond market. Well, the 6-month Treasury bill yield has moved down quite sharply. And we have seen that in the past, this 6-month bill rate tends to be rather active in expecting the Fed cut and only to be disappointed. Similarly, the 2-year has done quite badly in expecting the Fed cut. You see here that it was early call that the Fed will cut rate. No, the Fed raised rate instead. And here, market was expecting as many as 5 rate cuts. Okay? So now again, the 2-year is trying to price in a very aggressive Fed rate cut. Well, we look at the entire spectrum of the bond market. What we have seen is that currently the 3, 6, 1-year, 2-year have all moved below the yield curve a year ago, but the long end have moved up, right? Well, this is obviously expectation of the Fed cut, and this is a pressure due to increasing supply from the Treasury Department just to fund the deficit. I'm watching the dollar very carefully because what we are seeing is a triangle now, and if it breaks up, that would not be good for that would be good for inflation because it will suppress imported inflation. If it breaks down, then money may move from the U.S. to the non-U.S. market. Energy. Well, I'm fascinated with the amount of energy that's consumed by our data center. And now with AI, Gen AI, it uses up a lot more energy. And this data here is interesting because all the data centers, right, added together, is more than the energy used by many of these countries. So why am I interested in this? Well, obviously, if energy demand goes up, oil price would remain firm to higher, and that will be inflationary. And then I'm also watching gold as an indicator of risk on, risk off, as an indicator of inflation. And seasonally, we are going to expect gold to be trading up. So because of this seasonality, it probably won't have too much inflation implication. But nonetheless, I'm seeing central bank continue to buy, even though we have news that China have not been reporting recent purchases the last 2 months. It doesn't mean that they're not buying, it just means that they're not reporting what they're doing, right? So nonetheless, the other countries, excluding China, continue to accumulate gold, and we need to follow this closely because they may know something that we don't know. All right, Dan, back to you.
Okay, Mike, before I continue, maybe let me try to bring some of this together. We were talking last week about the 1970s, and you had mentioned that Powell doesn't want to repeat the mistakes of Arthur Burns, who was the Fed chairman 1970, I believe, to 1978. And you had mentioned that he had cut rates prematurely, which resulted in a sharp spike up inflation, which we all know occurred in the 70s. And also another interesting scenario, which kind of rhymes with today, is you had a situation where large cap, the large mega caps with very high PEs were the only stocks that were going up in the 70s. And it was called the Nifty 50 errors. And of course today we have the thing that rhymes called the Magnificent Seven. And so very interesting parallel. The other thing that happened in 1971, if you recall, was Nixon took us off the gold standard in 1971.
Mm.
So it's kind of very interesting now that central banks, as you've noted and we've noted before, are now buying gold. Ever since the financial crisis of 2008, central bankers had previously been net sellers of gold and buying US Treasury bonds, 10 years namely. And after 2008, they've been buying gold and been reducing their purchases of treasuries. So, very interesting scenario. A lot of it seems to rhyme with what happened in the 70s. Not sure how it's going to resolve itself, but it's a very interesting time. And people who look at the history and study it, certainly, like ourselves, certainly see a lot of interesting parallels. And it'll be very interesting how this resolves. And any
Mm.
other parallels or things that rhyme that you're seeing based on the 70s versus now? And I don't see a resurgence of a type of clothing, but
Yeah.
polyester clothing. No, I guess that was the 80s, polyester clothing, but fashion or whatever. But there's a lot of interesting things going on that seem to match what happened in the markets. So, any thoughts about that, Mike?
Yeah, I still continue to ponder over why why Power had talked about not wanting to repeat Arthur Burns' mistake, and yet last year he allowed 125 basis of expectation of cut, right? And the conspiracy theory would suggest that he wants to be reappointed and he wants to help uh, Biden get reelected. So after this event over the weekend, right? I think the situation may change politically, game theory wise, personal game theory wise, because if he knows that there's no chance of him getting reappointed under a Trump administration, then why would he want to take the risk on his own legacy by cutting rates too soon, right? And
Good
and
point.
uh, and and having worked in a central bank, right? I've been brought up with the idea that when central bank make a decision, it's always about which is the lesser evil, right? If we do A and we turn out to a mistake, can we correct it, right? So in this case here, if uh, if power doesn't cut, right, what can go wrong? What can go wrong, right? The economy is fine, the economy is fine. We're losing jobs slowly. It's fine. It's not accelerating yet. Nobody's complaining yet. The stock market is hunky dory. They're happy there, right? So why dish out the medication, right? Right now, and then 3 months later, 4 months later, based on what we have seen, inflation flare up, and he has to raise rates. He will be known as a second Atterburn. Why would anybody, after so many years of hard work, throw away his legacy like this to be written down in history as another dumb central banker? And for what?
Yep.
For what? Right? So it's
Very,
all very interesting how things are moving and how history is coming in, and then there's a slight twist here and there.
yeah. I like your points there, Mike. And I think the key data to watch will actually be the presidential polls. See if
Yeah, yeah,
see if the events over the weekend dramatically change the polls, one way or the other. And I like
yeah.
your point about the game theory with Powell wanting to protect his legacy if he's going to lose his position anyway if Trump wins. So very, very interesting. We'll be watching the polls very closely then. Okay,
Yeah, we should.
good dialogue there.
Yeah.
Okay, so turning toward the Magnificent Seven, um, basically 5 out of the 7 were down for the week, largely following the drop in the large growth in technology stocks, as I mentioned before. The only 2 names that were up for the week were Apple and Nvidia. The names are still very strong year to date, and it was nice to see them recover on Friday, along with a continued rally in small cap. So we'll be watching carefully to see if that continues, especially as the earnings season heats up. More on that later. Next slide, Mike. So for the sector performance, following the drop in the 10-year treasuries, real estate was the strongest sector for the week, up 4.41%, as measured by the Spider sector ETFs. That's what we're using to track all the various sector performance. Utilities were also up, not surprising as well. It's nice to see that traditional sectors that normally respond positively if a drop in interest rates are doing the right thing. So real estate and utilities up, slight improvement. Materials were also up. Pretty much all the sectors were up except for communication services down at the bottom. And the sector ETFs do reflect some more mid cap and some small cap exposure, which is why you see the more positive returns across the sectors. Next slide, Mike. In terms of the qualitative and style factors, spin-offs were the top performer for the week. And at the bottom, style, small cap was also the top. And pretty much seeing positive returns. The only one being down for the week was the Russell 1000 Growth ETF. In terms of qualitative and style factors, generally positive, and it's when you look at longer term, 1 month, month to date, quarter date, year to date, everything seems to be green. So so it seems that things are looking good in terms of whatever style. There is divergence though, but it's still pretty positive, almost double digits for pretty much all the factors. Next slide, Mike. So for commodities, we saw a drop during the week in most of the energy commodities as shown here. The only exception was ethanol being up for the week. Heating oil and gasoline were down, so relief at the pumps, which I'm sure consumers and drivers will appreciate. I think I saw a report there was some release of gasoline supplies by the government, which could have been a factor in reducing gasoline prices. So I'll watch that carefully. There was a request for bids to fill up some of the strategic petroleum reserve, but obviously that didn't result in any increase in crude oil prices. Turning to the metals, gold was the only metal that was up for the week. The rest of the commodities were down. Copper and aluminum are the two important ones, along with steel that we follow for the industrial sector. So we're still seeing weakness there on the industrial metals. Next slide, Mike. The agricultural commodities, for the most part, except for coffee, cocoa, and cotton, which were up, all the other commodities were down. A dramatic drop in rice, which is probably welcome news for a lot of the major countries, and include also soybean and wheat were down. So that's somewhat of a relief for most of the countries around the world to see those staples prices dropping. Next slide, Mike. I wanted to point out, I think the next 2 or 3 slides, point out some things that I saw during the week that I want to highlight, which could be signs of concerns. These are unrealized gains, losses on investment securities on bank balance sheets. So this is showing that, you can see, since 2022, there's been a dramatic large amount of unrealized losses sitting on banks' balance sheets. So there's probably going to be a day of reckoning at some point where banks have to write these losses down versus kicking the can down the road. So, and it may result in a need for some recapitalization or some rescues if the losses are significant enough. I think it's going to be more dramatic with smaller regional banks, because I think the the Fed's been paying much closer attention to the too big to fail banks, whose balance sheets, in my opinion, look a lot stronger. So among the smaller banks, we could see some stress. We need to keep an eye on that. Next slide, Mike. The other concern that noticed that was ticking up last week was credit card delinquency rates are now the highest since 2011. And I think it says 3.23%. So it's showing that the consumer clearly has some signs of stress with delinquency rates ticking up. So we got to watch that carefully. Continued increase, perhaps up to the 4% zone, should send some warning signals that the consumer is clearly weak. We're seeing a lot of stress in a lot of the consumer sector stocks. So, not surprising seeing credit card delinquency rates ticking up. They're just showing that consumers are being careful how they're spending money, and some are having trouble paying their credit card bills. Next slide, Mike. And this is a chart that just shows that for the most part this year, the top 50 stocks, if you look at the left, were supplying pretty much the majority of the returns. So bigger is better. The very small stocks among the S&P 500 were just not good performers. So pretty much for most active managers benchmarked to S&P 500, if you weren't holding the top names and you just were unable to outperform. So unfortunately, it hasn't been a good year for stock pickers because you just had to be concentrated in the mega cap names. So hopefully we're going to watch to see if that breadth expands and give some relief to stock pickers and active managers. But for the most part, just being in the index or just holding the top 10 names or so, that's where most of your returns would have come from. And if you weren't there, it was not good sledding. All right, next slide, Mike. Turning to the economic calendar for the week. This is Monday and Tuesday. Monday, and we see on the left highlighted in red are probably the key events. You have Fed Chair Powell doing another speech at 12:30. And then on Tuesday, important thing to watch, 8:30 a.m. is retail sales month over month. As I just said, that's probably going to continue to be under some stress. Previous month over month sales were 0.1%. The consensus is flat at 0. Forecast is 0.1%. So any continued degradation in retail sales could be a potential sign of trouble. Next slide, Mike. On Wednesday, key data will be the building permits, preliminary building permits, and it might be too early to see an impact from lower mortgage rates and building permits, but we'll see if there's any surprises there. Looking for 1.39 million. That's consensus. The forecast is 1.4 million building permits. We have a lot of other data out there, 30-year mortgage rates, industrial production data, manufacturing information, and energy inventories. A couple of bond auctions as well, Mike, which we'll keep an eye on. 17-week and 20-year auctions. And we got the Fed Beige Book, which is always an interesting read, coming out at 2 p.m. And that's more of I call it an anecdotal survey that the Fed governors provide, talking about what's happening in their district based upon what they're hearing or seeing. It's always a good read, and I like to read it. Next slide, Mike. On Thursday, got initial jobless claims, fully fed manufacturing index. A lot of the Philly data, some more auctions, a couple of speeches, and then Friday is going to be relatively quiet, couple of speeches, and some oil rig data. And well, the other thing that might be interesting on Thursday will be natural gas stocks. Been following natural gas prices as natural gas prices have been relatively weak. And I like to look at natural gas because natural gas is a important feedstock for baseload electricity generation. And as you mentioned, Mike, the data center demand has been very strong. And we really haven't seen a spike in natural gas demand. And even though the summer's been pretty hot, we really, really haven't seen that spike in natural gas, which we tend to see right now. So could be interesting if we see the big drop in inventories and a big pickup. There's still a lot of hot summer left. It's still about mid-July. We've got August to go through, and we'll see if natural gas picks up. Next slide, Mike. And we begin on Monday and the rest of the week with getting into the swing of the earnings season. These are the S&P 500 earnings that are companies that are reporting for the week. Monday, continuation of some financials. We saw some banks on Friday. A little bit of a mixed bag there. I know on Friday, Wells Fargo had reported they beat expectations, but they continue to see a compression on their net interest margins, and that resulted in the stock falling. BlackRock's an interesting one on Monday. As you know, they're one of the, I think they are the largest asset manager in the world right now. And be very interesting to see BlackRock's reports, Goldman Sachs reports. And on Tuesday, a lot more financials, and along with United Health, JP Hunt, Omnicom, and Charles Schwab, start getting some more insight into the rest of the economy. Next slide, Mike. Wednesday, I'm not going to read all of these, but again, we continue to get more of the smaller financials, some healthcare names. Prologis is a big warehousing real estate company. That's an interesting one because they do a lot of business with Amazon, and interesting to see Prologis's results. And running down the list. Next slide, Mike. Going to Thursday. Kinder Morgan, Steel Dynamics, United Airlines, Las Vegas Sands, Market Access, and I won't continue the rest, but next slide, just flip on Mike. And Friday. So it's a busy week for earnings. We'll be paying close attention to a number of them as we own a number of these names, and we'll see what the read is and what CEOs and CFOs are saying about recent results and what they're forecasting. It should give us a lot of insights, and also should lend itself to a fair amount of volatility in the markets as well. This will be very interesting to see what happens, especially after the news of last week on the interest rates and inflation, and also the assassination attempt on Saturday. So next slide, Mike. And that's continuing on Friday. Next slide, Mike. And just to close up, as always, if any of our viewers, clients, or prospective clients are interested in learning more about our products and services, or would like to schedule a meeting with Mike or myself, please contact Cleveland Ashley. His information is listed here. And any more comments or thoughts you want to share, Mike?
No, I think you covered all this very well, and as always, we are here to help any clients who would like to have a chat.
Great. Well, thank you. And this is Dan Liu and Micheal Cheah, AmericaFirst Wealth Management, signing out on Monday and wishing everyone a successful week of investing, and continue enjoyment of the summer. And let's all be safe out there, and let's wish all the presidential candidates and political candidates safety and success in articulating their points without any continued violence in the country. So thank you very much for tuning in. We'll talk to you again next week. Take care.
Right.